Welcome back to Project Pulse. Up to this point, we have covered all cases that assume at least some contracted revenues, full tolling, resource adequacy, and an auxiliary services contract with some merchant exposure. In this lesson, we are shifting gears into the fully merchant scenarios, and you will immediately see why this matters. Merchant exposure introduces more volatility in cash flows, and lenders typically respond with either more conservative leverage or sometimes no debt at all. You will also notice that one of the fully merchant cases, case 11, is modeled as all equity or unlevered, while the remaining merchant cases will use some leverage, but with a more conservative sizing approach than what we used under contracted revenues. If you're new to this Deal Lab series, I recommend starting with part 1, where you can download the model start file for free and build the model alongside me. Link is in the video description below. Now let's move to the information memorandum and anchor what we are doing today. We are now in monetization pillar 2, merchant and risk management. And in this lesson, we will model the two pure merchant cases, the 2-hour pure merchant case and the 1-hour pure merchant case. In both cases, revenue is a mix of merchant energy arbitrage and merchant auxiliary services, meaning nothing is contracted. We are fully dependent on market pricing and dispatch. In the first column is our 2-hour battery. This one is intentionally modeled as all equity, meaning no term loan. That's often a realistic outcome in merchant-heavy projects when lenders aren't comfortable relying on market revenues for debt sizing. In the second column is our 1-hour battery. This one assumes some leverage, but lenders apply a conservative approach. Specifically, for sizing they assume a 20% haircut to merchant revenues, basically saying we'll only give you credit for 80% of the forecasted merchant value when we test that service. And from a sensitivity standpoint, lenders want to run a break-even analysis. The purpose is simple. How far could the forecasted merchant revenue fall in each period and the SPV would still be able to meet its scheduled debt service? So instead of asking, what's the base case DSCR, break-even asks, what's the margin of safety in the merchant forecast? Alright guys, now let's move over to the model checkpoint file from our previous lesson. And I've already flipped to case 11, which is our 2-hour pure merchant case. And this 2-hour pure merchant case we will only look at from an equity perspective because lenders will not be willing to provide any debt on this fully merchant structure. So in this case, we do have a 2-hour battery and our revenue comes from two sources. Some of it from our merchant energy arbitrage, and we'll also assume some merchant auxiliary services. Let's scroll down and you will see that from a merchant energy arbitrage perspective, 60% of the revenue is assumed to come from merchant energy arbitrage. Or better, not 60% of revenue, but 60% of the installed capacity at the point of interconnection will be used to materialize merchant energy arbitrage revenue. From a cycles perspective, we are assuming 260 equivalent full cycles per year, which is slightly less than our 1-hour battery, because a 1-hour battery will give us some more flexibility to run equivalent full cycles than a 2-hour battery. Then we are also in both cases assuming some merchant auxiliary services, and the reference duration for all of our different auxiliary products, such as regulation up and down, spinning reserve, non-spinning and supplemental reserve, and fast frequency response, all of these schedules depend on either our 2-hour forecast or our 1-hour forecast provided by our independent engineer or merchant forecast provider. And you will see that from an augmentation standpoint, we actually do need to restore 30% once the augmentation is triggered. And let's just see what happens if you would type 20% like in a previous case. You would see that we would get a augmentation fail. And why is that? That is because our fully merchant cases assume a much more frequent cycling than our contracted cases. That means the battery will degrade much faster and we will have to restore more capacity at the two different augmentation events that are built into the model. So you can see the significance of our major maintenance reserve account. We really have to take out quite a significant portion of our cash flow to save up for our different augmentation events. Let's just compare that to case 1 to just demonstrate how much more cash flow is necessary here. And you can see in our fully contracted tolling case, we actually just have one small augmentation after roughly 13 to 14 years of operation, while in a fully merchant case, the augmentation actually occurs twice and is much larger. And that is one of the major reasons why our levered equity IRR, in this case it actually equals our unlevered after-tax project IRR, because we do not have any leverage. And that is the reason why this IRR is so low. So not only do we have to augment more, but our total revenues are also smaller. And that truly just depends on the forecast assumptions. But for our case study purposes, the merchant forecasts are not as strong as our fully contracted revenue cases where the SPV would earn much more cash flow from contracted sources. Let's move back to the inputs time independent sheet. We're still in case 11. And our debt sizing is turned off because we do not have any leverage that we can assume here. No lender was willing to provide us any leverage. So all we will do is hit our master macro once to make sure that the outputs for case 11 are actually pasted into our scenarios sheet. And then we are already good to move to our next case, which is case 12. And that is basically very similar to case 11. Again, it's a fully merchant case. This time we have a 1-hour battery. And it seems as if lenders have more confidence in a 1-hour battery over a 2-hour battery. Maybe because there's some more flexibility to actually earn arbitrage revenues more efficiently than with the 2-hour battery. Just because our duration is more limited, meaning that this battery might be more effective at earning the spread through buying at low prices and selling at high prices. So let's scroll down, and you will see that the major difference here is that we have more equivalent full cycles for arbitrage purposes, and we also assume more merchant auxiliary services revenues in case 12 versus case 11. So more of the capacity of the battery will be used under a merchant auxiliary services assumption than under merchant energy arbitrage. Okay, let's scroll down further. And similar to our case 11, we have a significant portion of our cash flows that will be required for our 30% augmentation. And then this is also an input that we have from our information memorandum. The maximum leverage that lenders are willing to give in our fully merchant cases, 12 to 14, is 40% leverage and a maximum of 10 years debt tenor. So you can see this is a much more conservative assumption than our fully contracted or partially contracted cases. Scroll down further, and in addition to that, in case 12, which is our debt sizing case, we also assume a 20% haircut on both merchant energy arbitrage and merchant auxiliary services. And so far we haven't executed our master macro yet, which means that for case 12 we do not have our debt schedule yet. So let's hit the master macro now. And you might have noticed that our equity IRR actually went down a bit. Right before I executed the macro, it was around 5.76%. Now it is at 5.63%. And the reason being is that our cost of debt appears to be more expensive than our unlevered project IRR. And that ultimately leads to a levered equity IRR, which is lower than if you would just turn the debt off. So let's just demonstrate this really quick. If you would turn the debt off and say this is 0% leverage right here, hit our master macro. Oops, let's go to the inputs time dependent sheet. That didn't fully work. So because if we have no input right here, what actually happens is that our maximum leverage constraint from case 1 is picked up. So we actually have to type in a hard 0. So let's try that again. And right now our unlevered after-tax project IRR is actually at 5.57%. So it is actually slightly lower than our levered equity IRR, which means that our cost of debt is right around that area right here, which means that leverage can materially improve our levered equity IRR just in a very minimal manner. But we have to remember that in this case, we are in our debt sizing case. So let's type in 40% again, hit the master macro so that we get our debt repayment schedule in our inputs time dependent sheet. That shows that for a period of 10 years, we will size our debt at a 2.0 DSCR, which then ultimately also translates into a 2.0 loan life coverage ratio because our DSCR profile is flat. And although we would be allowed to raise that up to 40% of CapEx, our DSCR sculpting actually restricts or constrains us at 31.6%. But now we also want to see how this actually affects our levered equity IRR in our equity base case. Because right now we are still assuming a 20% haircut for merchant revenues. And that will change once we switch over to case 13. So switch to case 13. And that is actually not the equity base case, so let's switch to case 14 instead. And for case 14, we want to make sure that we have the same debt repayment profile. So pick up this row here and paste it in for case 14. Go to the dashboard, hit the master macro once, and you will notice that our levered equity IRR has materially improved significantly, and we are actually barely above hurdle. So you can see how much impact a 20% haircut on merchant revenues actually can have, especially from a equity IRR perspective. So now in comparison to case 12, we see that our cash flow waterfall is much richer than in our debt base case, which leads to 99.5 million in CFETs, and case 14 actually leads to 131 million in CFETs. Okay, and that means that we now have our debt sizing case for the 1 hour battery as well as our equity base case. And the last thing we are missing is in case 13, our break-even analysis. So let's move to case 13, hit the macro, and right here there's already the proper output, so we will just delete that for now. And what we need to do first is copy and paste our debt repayment profile right here again. But let's just demonstrate one more time how we could do it alternatively, as already demonstrated in previous lessons. So what we could do right here is assume a 20% haircut. For both cases, turn our debt sizing on. We'll get a warning because we are in a sensitivity case right here. Execute our master macro. Move to the inputs time dependent sheet, and you will see that the repayment profile now is identical to case 12. Then we move back to case 13, turn our debt sizing off so that our hard codes are picked up in the operations sheet. And then what we want to determine is, in our dashboard right now, you see that our average and minimum DSCR are at a 2.0. Meaning that in each period, our debt service will be covered twice just from merchant cash flows. But since there's so much uncertainty in the merchant cash flows, what lenders often want to understand is how much could the merchant energy arbitrage and auxiliary services price forecast actually decrease to ensure that lenders still get their money back in each single period. And to do this, we can run a break-even analysis, which has already been set up in the model in row 314. And here, first, what we'll have to do is in row 310, we want to refer to cell 314. And the same goes for row 311. That's referred to 314. And in row 314, we can just type in a hard code. Let's do minus 20% for now, which is that sizing case haircut. And that would still lead to a DSCR of 2.0. Then we could technically try to sort that out manually by saying what happens at minus 25%. Move to the dashboard. You will see our overall DSCR profile has decreased, but we are still way above 1.0. So to determine that more efficiently, we can use the goal seek function in Excel. And what we actually pull in right here in our sensitivity section is our minimum DSCR. The minimum DSCR is coming from our operations sheet, where we look up what the minimum DSCR is, including our sweep scenario, and at what date. So if you move back to the inputs time independent sheet, we can jump into cell V314, hit Alt A W G for our goal seek function, and then we want to set the cell of our minimum DSCR output to 1. So we want the minimum DSCR to be 1, which means that service is effectively covered by 100%, but not more and not less. And we want to achieve a minimum DSCR by changing our cell B314, which is the input for our merchant haircut. So click that arrow here, hit OK. And just with a few iterations, we will have determined that a merchant haircut of 41.73% leads to a minimum DSCR of 1.0. And you can see that this negative 41% feeds into cells B311 and 310, which is then picked up right here in our live case. And that flows into our operations sheet right here. And what we basically do is just reduce our total revenue by 41%. So it's important to understand how we interpret that figure. It's basically just a reduction in revenue. It is not a reduction in our price spreads. So you will see that in our inputs time dependent sheet, we have different assumptions for merchant arbitrage forecasts and for our merchant auxiliary services. So that sensitivity does not increase the average charge price or decrease the average discharge price, which sometimes could be confusing to lenders and credit decision makers. But instead, what we just do is simply reduce our overall revenue for both cases. So we can say that even if we only achieve roughly 59% of the forecasted revenues, which is more than the 80% of revenues that we assume in the debt sizing case, which assumes a 20% haircut, then lenders would still get their money back in each period. And you will also notice that the 1.0 DSCR actually only kicks in one single period. And in the other periods, we are still well above 1.0. And you will see that in 4 periods, which are the periods where our major maintenance reserve account is being built up, and you can see we do not have as much breathing room cash flow wise as in the other years. That is when we will also be in lockup. So you can see that our cash on cash yield drops to 0 from year 2030 to 2033. And that is because our DSCR is below our lockup level, indicated by the red dashed line. All right, let's move over to our scenarios output sheet. And we can already see all outputs for our previous 14 cases. But to demonstrate one more time what our scenario macro can do is we just take all of these outputs, which are all hard codes, delete them, And then we will run all cases up to case 14, which we have modeled in this lesson, and execute a macro. Great, hit OK. And we can conclude that although we are taking much more risk from an equity standpoint, we actually do not earn a superior equity IRR on a levered basis in comparison to all our other contractor cases. So actually our levered equity IRR for the fully merchant case is significantly worse than the equity base case IRR for our other 3 cases. So in our full tolling case, we actually got a 13.8 levered equity IRR, and the resource adequacy in combination with the merchant arbitrage case, we got 11.4%. And in the auxiliary services contract with arbitrage revenues, we actually got 13%. So that clearly indicates that from both a lending perspective, a fully merchant battery is not as desirable as well as from a equity perspective. And that, of course, is only based on this case study, but these outputs do help to interpret both contracted and merchant battery structures pretty well. All right, guys, this was it for our fully merchant cases. And in the next lesson, we will implement a revenue put option, which is a financial hedging instrument designed to put a floor under merchant revenues. So the goal of the next lesson is to create more predictable cash flows, which should give lenders more comfort and in many cases enable more debt capacity than a pure merchant structure, as demonstrated in this lesson, would support. All right, guys, this was it for this lesson, and I will see you in the next lesson. See you there.